Lesson 3. Types of Indicators and Oscillators. In the previous video, you learned an unambiguous way to identify the trend quickly and easily without the need of acquiring a lot of knowledge on technical analysis. So the question is, why did you need to learn how to identify the trend first in such a practical manner? Because that is the only direction you will be putting orders during your trading session, and it is the very first step in our top strategy. Our objective is to identify the market conditions with the highest probability of success before we place an order. And in order to do that, we use a moving average to identify the trend. Then we take the aid of different indicators, including top, to help us to manage our trades. I'm sure you've heard about lagging and leading indicators. But who are we kidding? All the indicators found on a trading platform, no matter how good or modern that platform can be, and no matter how clever the calculations for the indicator are, they are all lagging indicators that show how the current price relates to past data. The indicators by themselves have very little predictive capabilities. That's up to the analyst to interpret, and that is precisely the function of technical analysis. So is there such a thing as a leading indicator? We could think of it like this, that a sound analysis that prepares us in advance for ideal trade conditions could be defined as our leading indicator. In top, we arbitrarily divide indicators into 3 types. 1. Oscillators, like stochastic, rate of change, RSI, percentage R, and others. 2. Trend following, trend lines, moving averages, MACD, unbalanced volume, and so on. And finally, we have 3. Psychological indicators, daily sentiment index, the commitment of traders report, the headline indicators, news, and others. In our technical analysis course, we will be dealing in detail with some of the oscillators and trend following indicators. Suffice it to say that oscillators are also known as momentum indicators, and they can be extremely helpful if used at the appropriate time. Most oscillators use the high, close, open, or low of a price bar to make its calculations. Oscillators look back over a given period, make calculations, and then compare the recent price position with that of the given period. That's all. One should not expect to get valid and consistent trade signals out of that. Psychological indicators provide information about the sentiment of the people involved in the market. They're based on the belief that if the majority of traders agree on the direction of the market, then prices will likely move in the opposite direction. That is known as the theory of contrary opinion, and it has been used by expert analysts for many years effectively. However, psychological indicators are not timing tools, so in as useful as they are to the trained analyst, they are not going to help you time your entries and exits. Therefore, we will not be covering them in our technical analysis courses. For example, the headline indicator simply means that when newspapers, magazines, TV, and the whole media recognize the trend in a particular direction, it's too late to enter the market. If the media is saying that one should buy, it will not be long before the trend turns down, but it may be weeks or months before that happens. So in order to have an effective strategy that you can use immediately to time your entries and determine your targets, we will focus on oscillators and trend following indicators. But we have to be extremely careful because their signals can be opposite and mixed. They can be extremely helpful only, however, if used as part of a sound trading plan that includes analysis to determine the phase of the market or the type of trend the market is in. So in the next video, we will show you the secret to use momentum and trend following indicators.